Hello to everyone. Today I am here with Introduction to Corporate Finance Part 3. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover what is debt, debt, types of short-term loans, types of long-term loans. What is debt? Debt is an obligation to pay a specific amount of money to the lending party on the agreed terms. Normally, we used to borrow the money from the lenders. Lenders can be any type of a financial institution like commercial bank, development financial institution, investment bank, leasing companies, etc. Characteristics of the debt. On one side, we have short-term versus long-term, fixed versus floating interest rate, secured versus unsecured, domestic versus foreign. So these are the characteristics of the debt. Debt is characterized in on one side as secured. Secured loans are backed by any type of security. Security can be tangible, like mortgage of movable and immovable property. On the other side, it can be intangible, like lien on any type of deposit, or you can say guarantees. These are the type of intangible security. Unsecured loans not backed by any type of security and also called as clean placement. Normally we have the case or we have the example of unsecured or the clean placement include credit card. Most of the people having the credit card that is not backed by any type of security. On the other side, that is also categorized in two categories. Short-term loans repayable less than a year, maybe up to 364 days, because a year completed at 365 days. Long-term loans repayable normally in between 3 to 5 years and may vary depending on the nature of the facility, like in case of home mortgage, may extend to 20 years plus. Short-term loans are categorized in multiple categories like revolving loans. It's very interesting. Repayable less than a year with the option to avail the facility up to maximum limit. Pay it back and borrow again as needed. For example, the limit against the revolving loan is 20 million. You can borrow 10 million, then if you need further, you can borrow 5 million, then 2 million and 3 million. And when you find that you have the amount, you can adjust as well. 5 million comes from somewhere, you have adjusted the revolving loan. So in this way, the revolving loans work. Revolving loans are normally against the working capital loans. Working capital loans are to meet the production need. The time you need to purchase the raw material, you can avail it. And after having the amount received against the proceed of finished goods, you can adjust it. So the revolving loans allow you the multiple transaction. Running finance is also a type of revolving loan to meet the day-to-day business expenditure deficit. Sometimes you didn't receive your inflow as expected. So in that case, to meet the deficit, you can avail the running finance. Third one is the seasonal loans. They are against agri crops like wheat, rice, or we call it paddy, maize, cotton. So crop comes once a year, but you required it throughout the year to meet your needs. Thereafter, credit card to meet the corporate or individual short-term needs. So it is an other example of short-term loans. They are also categorized in multiple categories like fixed-term loan repayable based on the maturity of the transaction. We have the examples related to fixed-term loans here, discounting of negotiable instruments like posted checks and or letter of credit. So its discounting is also a type of short-term debt. Personal loans borrow finance for short-term. Bridge loan, it is also used to bridge the gap against the equity or the long-term financing. Normally, bridge loan is utilized against any type of IPO. You got the permission, you are in the process of floating the IPOs. It may be against the equity instruments like shares or against any type of bonds or term finance certificates. So it might take a period of 3 months. To bridge that 3 months, you can borrow the bridge loan, and after receiving the proceed of your IPO, you can adjust that bridge loan. Long-term debt are normally required to meet the business capital expenditure need. In order to start a business, startup, to enhance the existing capacity, change of technology. So the capital expenditure are normally need in these three scenarios. Other types are bonds and TF, term finance certificates. So it is also it's a type of debt instrument. That is a type of long-term debt. Other include the mortgage. There are mortgage bonds, and on the other side, the mortgage loans are also the type of the long-term debt. Thank you very much. See you again with the upcoming video on the same topic very soon.